What's up, guys? I'm Mike from StockedUp. In this video, we're going to be going over a super important lesson for options trading. Now, this lesson has to do with implied volatility and options pricing. So make sure you watch to the end. We're going to be going over a lot of important lessons to go over, and this video could be very beneficial. So make sure you watch to the end. So if you've been paying attention to the market this week, you know Tesla and beyond have went insane. So from last Friday, Tesla went from $478 to highs of $547, right? Beyond went from, Beyond went from last Friday, it was at $96. 2 days ago, it hit highs of $135 each. Now, they just went insane, had a huge uptrend up, both of them, and, they were very, very volatile. People, obviously, everyone knows that, and, some people might think, all right, if we know Tesla and beyond are so volatile, and, let's say they don't know anything about options pricing, why don't I just buy a call and a put? Because either way, they're probably going to move so much, so whether it goes up or down, it doesn't matter. Now, while this thinking in theory makes sense, options pricing pretty much debunks that. So pretty much what happens is the more volatile a stock gets, the more expensive their options get. The more expensive their options get, the higher implied volatility is. So on Tesla, before Tesla started going crazy, like in the middle of December, implied volatility was at 37%, 0.37. Now, when it is going crazy, it's moving up, down, it's at 71%. Beyond, it's pretty much the same thing. Beginning of January, implied volatility, 56%. It wasn't moving, it was just flat. Implied volatility right now is at over 100%. So that being said, this teaches us a very important lesson in terms of options pricing. So, we could see Tesla today fell by about 1%, right? So in theory, the puts should go up because the stock fell. Let's take a look at the options chain. The puts, pretty much all of them are down. The calls, all of them are down. Now, you're probably thinking, well, if Tesla fell today, why are the puts down? Like literally, the at-the-money puts right now on Tesla are down 20%. A little bit out of the money puts on Tesla are down 62%. So this has to do with expected moves in implied volatility. So when you're trading stocks with high implied volatility, you need them to move a lot. Like just because Tesla fell $5 today, you need them to move a lot more than $5. To find the exact number, you'd have to use the Black-Scholes model, but there's like a shortcut on Thinkorswim. It shows like the expected move, so that would show you like the first standard deviation of expected move. That's a little complicated. We're not going to get into that in this video. I have a lot of other videos with expected moves. Just type in Mike D'Antonio, expected move or standard deviation on YouTube, and you will find them. But anyways, with Tesla, just a $5 move down doesn't work. That's not good enough, and the options fell. So even with Beyond, everyone knows that Tesla and Beyond are moving up and they're going crazy. But, what beginners and even some like moderately experienced traders, they don't know is that it's not okay for Beyond to just go up a little bit. Like Beyond went up 3% today. That's a lot. For like Dow stocks, that's huge. But for Beyond, that's nothing because implied volatility is at, 100%. So if we go to Beyond, even though Beyond went up 3%, we could see that the call options only rose by 2% and the puts fell by 60%. Some of the other call options fell too, 11%, 14%, 29%. So it's not enough just for you to be right. You have to be right big time when you're trading implied volatility stocks. So if there's one takeaway from this video for you is if you are trading high implied volatility stocks, know that you need to have a huge move. And this is why I don't like to play earnings because they're all high implied volatility. So you have a 50% chance of predicting earnings right. And let's say you predict right. You still need the stock to move, X amount to the point where you could even profit. So there's a lot of variables, and this is why the best thing to do would to, not trade high implied volatility stocks. You could trade Tesla and beyond, when they're in the starting stages of the uptrend, like when implied volatility just started rising. But after this huge movement and after implied volatility pops so much, you can still trade these stocks. You still can make money, but it's a lot riskier. So, for example, on Tesla and beyond, I sold call credit spreads on both of them. Pretty much, I sold the 620 strike call on Tesla, right? And the way I was able to do this is I got about a 6% return. It's not a crazy return, but when you're trading with larger amounts of capital, it adds up, and especially in a week too. So the thing is I got a 6% return on Tesla, and the only way I would lose is if Tesla hits or goes over $620 by tomorrow. So I entered this trade earlier in the week. I entered it on, on what was that, Tuesday. So the thing is you have to look at the chart, look at Tesla and see, is Tesla really going to go higher than $620 by Friday? Most likely not. I can lose, it's possible, but most likely not. So this is just a big lesson to learn. Keep in mind implied volatility when you're trading, and it's not about percentage wise. So for example, if we go to so if we go to beyond, right, you'll see the implied volatility is 89%. If we go to Verizon, the implied volatility is 16%. So when I say high implied volatility, I mean it relative. So for example, right now, Verizon implied volatility is at 16%, and at one point beyond implied volatility was at 56% right here. It would be okay to trade beyond right here. It's just it's like a recent IPO stock, so it's naturally going to be more volatile. The thing is though is don't look at implied volatility in terms of numbers like 56% or whatever. Look at it relative to its past. So for example, right now on beyond, here's the implied volatility now. Here was where implied volatility was at a month ago. Here's implied volatility a couple months ago compared to earlier this year. For example, beyond implied volatility is high right now. I can tell because right now it's right here, and in the past it was down here. So look at it relative. Main takeaway from this video, if you're going to trade high implied volatility stocks, be very careful. Know that you need to, one, be right, and need to be right big, right? So I want to thank everyone who watches the videos and more importantly comments. The YouTube channel has been exploding recently, and you guys have a huge part in that. So I just want to say thank you guys. Thank you to everyone who comments, likes, and subscribes. Thank you all. If you have any questions, let me know in the comments down below. But other than that, thanks for watching.